Sujit is an advocate specializing in tax matters and is based in New Delhi, India. Sujit qualified as a lawyer from the National Law School of India University, Bangalore in the year 1995 and has 25 years of experience in tax laws. Sujit has started his career with Arthur Anderson in the year 1995 in the indirect tax practice of the said Big Five international accounting firms until its global dissolution in the year 2002. Thereafter, in 2002, Sujit joined Ernst & Young in their indirect tax practice and was inducted into their senior management and group head team. In the year 2004, Sujit went on to set up a boutique tax consulting firm by the name BMR Advisors and he was one of their founding indirect tax partners. In the year 2010, Sujit founded BMR Legal and shifted his professional trajectory from tax consulting to tax litigation. In the year 2013, Sujit left BMR Legal to set up Advaita Legal, a boutique tax litigation firm, and was the national head of the said firm for over 5 years until the end of January 2019. Thereafter, at the end of January 2019, Sujit demitted office at Advaita Legal to set up his own independent chamber practice by the name of Chambers of Sujit Ghosh and has been operating and acting as an independent arguing counsel for his clients and also a counsel representing clients of Big Four accounting firms and other accounting firms and law firms. In these years, as a tax litigator, Sujit has been acting as an arguing tax counsel in areas of indirect taxes, which includes GST as well, customs, DGFT, and constitutional law. He has several landmark decisions to his credit on indirect tax and income tax matters. Sujit is a regular speaker at various industry fora, including FICCI, CII, ASSOCHAM, PHDCCI, and so on and so forth. The list is never ending. And Sujit is also a regular resource person for the past many years at the National Judiciary Academy, Bhopal, and delivers classroom lectures to High Court judges from across the country on tax, constitutional law, and also administrative laws. His accolades, recognitions, and achievements are innumerous, and it will continue going forward in the future years to come. Now, with this, I request Sujit sir to please take over the proceeding. Sujit sir, you have got complete next 2 hours at your disposal, which will be followed by Q&A for about 15 to 20 minutes. Sujit sir, over to you. Thank you.
Thank you, Ganesh. Thank you all. Good evening, all of you. I hope you had a good Saturday. And I was told that the association does a lot of good work in terms of
Sir, you are muted. Please unmute.
Can you hear me all?
Yes, sir, we can hear.
Excellent. So, good evening, everybody.
Sir, please open the mic.
Am I not audible?
Sir, you are audible. Go on, sir.
Okay. So, thank you for inviting me today to your association deliberation. I understand your institute or your association does a lot of good work in training, imparting training to budding chartered accountants, experienced at the seniors as well. So I have 1.5 hours and then maybe 20 minutes of question answer. So 2 hours is what we will try and spend today on something which is rather intriguing in the context of taxation. So while I have a presentation for you all, but before I jump to my presentation, I wanted to share some thoughts on that subject. So what I have been asked to talk about is taxation of immovable property and liquidated damages. Now, there are two different aspects, but somewhere related as well. Uh, Immovable property. How do you understand what is an immovable property? How is it distinct from a movable property? How is it distinct from a service? These are things that needs to be first appreciated before we go into the taxability of that. If you look at a constitutional framework, after the constitution got amended, 101st constitution amendment, where Article 246A was introduced, a new definition of service was incorporated in the constitution itself. I think 3612A, I think, if I'm not mistaken. And they defined services to mean anything other than goods. So when you define any services to mean anything other than goods, and goods is very clearly understood, and it has been understood for the longest time that anything that is movable is goods. Any article that is movable, of course, subject to exceptions, which would mean that of the universe, the movable things are on the one side, and the immovable things or anything that is not movable is nothing but services. Stricto sensu, under the Constitution, services as defined would include immovable property, because services is anything other than goods, and immovable property is not goods, and therefore immovable property becomes service. The problem is that the moment you define services to be in that manner, and you look at Article 246A, which gives the power to levy tax or GST, and GST is defined to mean tax on goods or services of both. There is a fundamental presumption that comes out that GST can also be levied on immovable property. Because if somebody is talking, okay. So when 246A read with the definition of GST is looked at, it gives a clear indication that the power to levy GST is on supply of services, goods, services of both. Goods we understand, services are capable of covering immovable property, as I mentioned, and therefore 246A is capable of levying tax on immovable property. But at the same time, the very same constitution under entry 49, entry 18 of list 2 confers power on the state government to legislate on land, building, etc., and at the same time confers power to levy tax on land and building. So the difficulty that exists is that today under 246A, and this is a very technical one, under 246A, there is a power to levy GST on immovable property. Under entry 49 and entry 18 of the list 2, the power to levy tax on immovable property is with the state government. So there is an apparent conflict, obviously, because we all know that if in the fields of legislation falls within the domain of the state, then the central government cannot. But insofar as the field of legislation for state is concerned, state is quite competent to do so, because it has a power under 246A as well as entry 49 and entry 18 of the list 2. So the real question is, what happens to the central government's power? Can it at all levy, or is GST leviable on immovable property, or what is the position there? And mind you, 246A starts with a non-obstante clause, which means 246A said notwithstanding anything contained in 246. And 246 gives the distribution of power between the central government and the state government. And therefore, you have to go to the list 7, schedule 7, list 1, list 2, list 3. So technically speaking, for everybody's benefit, constitutionally, because 246A can override 246, and therefore the limitations that are available for the central government or the parliament not to be able to legislate on land and building because it falls under entry 49 and entry 18 of list 2 is technically not there anymore, because 246A starts with a non-obstante clause. Therefore, do remember that under the constitution, GST can be levied on immovable property, and the reason for that is GST is defined to mean a tax on supply of goods or services, or both. Services has been defined to mean anything other than goods. Anything other than goods will of course include immovable property, because the element of economy that goes into production, value creation, etc., includes man, labor, and property, right? Internationally, GST is levied on immovable property. So there is no reason why GST can be said to be antithetical, or levy of GST can be said to be antithetical. But the other side of the story is that the intention of the legislature is certainly not to impose a tax on land, and therefore, if you look at your Schedule 3, there is a schedule in your GST legislation which says activities which will not be treated as supply of goods or services, and sale of land and building is something that has been prescribed therein. Okay, so today, while constitutionally there can be a debate, there can be a discussion insofar as the propriety of the parliament is concerned on taxation of land and building, but by virtue of a specific statutory implementation, which is your Schedule 3 of CGST Act, the parliament has very clearly said that we don't intend it to be treated as a service, notwithstanding the wide sweep available to the definition of a service under the Constitution. Even the CGST Act also defines services to be anything other than goods. So they've kind of borrowed the definition of services from the Constitution. So I want you to keep this in mind each time you are dealing with an immovable property in terms of the taxing power of the federal government or the state government in the context of GST. So that's the first and foremost thing that I wanted to bring about. Now let me quickly jump to the presentation that I have for you, and let's see what we can do about it. Where is my presentation? You see, if I load some relevant presentation, pardon me, okay? I don't know which one is getting loaded. No, I think I loaded the wrong one.
Yes, sir. It's projecting. It's fine, sir.
No, it's a wrong one. It's a wrong presentation that I've created. Okay. Okay, let me see. There are so many presentations that are open. Is that visible to all?
Not yet, sir.
Not yet. Okay. Okay, hold on. Yeah.
It's perfect.
Perfect. Okay. So here we go. So we spoke about Schedule 3, Section 7, activities neither treated as goods nor as supply, right? And we have this entry which says sale of land and building post completion certificate. Now, what is interesting to note is that they make a distinction between the stage at which the property is at the time of the transaction. They seem to be making a fine distinction between the stage at which it has reached completion and therefore a completion certificate has been issued, and a stage at which it is work in progress, which to my mind seems like a very artificial distinction. To say that merely because completion certificate has not been issued, it loses its relevance as an immovable property. That to my mind goes against the very grain of what is immovable in the context of the Transfer of Property Act, in the concept of the General Clauses Act, and so on and so forth. So this whole artificial distinction insofar as proprietary to levy tax or GST on construction of a new property before completion certificate has been issued seems to be a suspected transaction, and we can always raise the constitutional bar that merely because completion certificate has been issued or not been issued does not mean that it is not an immovable property. And if there is an immovable property status to a particular property that is available under the General Clauses Act and Transfer Property Act, then how far can the state government, can the federal government encroach upon the powers of the state government to levy tax under Entry 48, that I just mentioned about. But aside of that, what we need to also understand is what does land mean? What does sale of land mean? When you sell land, what are you selling? So land is essentially the proprietary ownership over land is essentially a bundle of right that you have with respect to the asset in concern. And that bundle of right could be user right, possessory right, right to exploit, right to transfer, right to do whatever you want to do, right to alienate. Various kind of these bundles make what is called an ownership right. Of this, there is this one concept called the profit appendage, concept of interest in the land. So, for example, let us say you have a land which has a number of trees, and the trees are fruit-bearing trees, or for that matter, let's say there is a land which has lots of animals there. It could be regular cattle, which has a cash value in terms of the produce that they make. So anything of that sort where there is an interest which can be alienated by the parties that exist on that piece of land. Such an interest, if it is transferred to a counterparty without transfer of ownership over the land, such interest that accrues to the transfer is called profit appendre. So a profit appendre is essentially a right to take something of another person's land. It may be fully defined as a right to enter another's land to take some profit of the soil or a portion of the soil itself, or for the use of the owner of the right. And such an interest in property, and there are some examples that I have given. The subject matter of a profit appendre, namely the substance which the owner has, etc., could be animals, including fish and flora, which are on the land, or vegetable matters growing or deposit of on the land, minerals, whatever, any interest that accrues on the land, underneath the land, in relation to the land, around the land, over the land, whichever way you put it. If that interest is alienated to a third party, and the third party therefore is rightly vested with such a right, such a privilege to be able to go and exploit that interest, then such is called a profit appendre. A classic example of a profit appendre could be development rights on land. You have a right to construct, you also have a right to transfer, you also have a right to develop. So the right to develop the land, which is nothing but a profit appendre in many ways, is transferred to somebody else. Can we say that such profit appendre should also be not liable to GST by virtue of Schedule 3's entry, which says the sale of land? In other words, when the legislature uses the word sale of land, does it subsume sale of land, or including its interest arising in relation to the land? Okay. So now, why is it not moving? Yeah. So if you look at the immovable property, the definition, so if you look at the General Clauses Act, section 326, it says immovable property includes inter se benefits arising out of land. So in immovable property includes benefit arising out of land. Registration Act under section 2F talks about immovable property to include benefit arising out of land. Land Acquisition Act talks about land to include benefits that arise out of the land and things attached to the earth or permanently fastened. Bombay Land Revenue Act Code defines land to include benefit arising out of land. So there are lots of legislative backing on this whole concept of the land qualifying as, the interest in land qualifying as immovable property. And if that be the case, then can we not say that every time there is an interest in property that is transferred, which is development rights or whatever else, it is a sale of land, and the sale of land will therefore not be liable to GST, and therefore that is a position that the court should take cognizance of. So these are the two judgments that they make it very clear on profit appendre. So one is Supreme Court which said that profit appendre is a benefit arising out of land, and that in view of clause 326 of the General Clauses Act, it is an immovable property. And then in Titagarh, Supreme Court says that it is effectively an interest in land. So mind you, there was a judgment of the Bombay High Court where they're in the erstwhile law, and there are some tribunal decisions also where they seem to be aligned to this concept that should there be a transfer of interest in land, it will be treated as sale of land. So I would believe that we can start looking at non-GST non-leviability of GST insofar as such interest transfers are concerned, particularly in keeping with this jurisprudence of profit appendre. So that was the first thing on profit appendre that I thought I'll speak about, and it could be relevant not only for interest in land in terms of the development right, it could be also in the context of mineral rights that are there. All of you are in Karnataka. Karnataka is a mineral bearing state. There are minerals that are excavated. There is a royalty that is paid to the state government for exploitation of the royalty. But the ownership of the land and the mineral that is underneath the land always belongs to the central government or the state government concerned, depending upon whether it's a major mineral or minor mineral. And therefore, if they are leasing out the property to you, are they not effectively giving an interest to exploit the land? And therefore, under that circumstances, can we not say that the royalty should not be liable to GST? Because at the end of the day, it's a profit appendre arising out of the land. Okay, so that's one point that you can start pondering and do your research and take your clients to the logical conclusion where it needs to be. That's the first one. The second one, 17.5C and D. Now, That's the other aspect on GST on immovable property. Now, very surprisingly, I don't know why the government, for some weird reason, seems to be denying the credit on immovable property ever since it was first introduced under the service tax era. Even in the service tax era, if you remember, the definition of input services and when you can claim credit, they would say excluding immovable property. So this whole fascination or aversion to grant credit to immovable property seems very strange. Probably because there is a huge amount of revenue loss for the government, because constructions are generally of large magnitude and value concerned, and therefore if they start giving credit on that, they are likely to lose money. So, but that is not rational, because if it is a consumption tax, if it is a consumption tax where you are supposed to maintain tax neutrality, to make sure that the businesses do not pay tax and the tax should go to the consumer, restricting of this credit on construction of an immovable property seems to be quite bizarre. In fact, I remember, I know many of you would remember, under service tax era, there was actually a circular which they had issued to say that since there is a break in the chain, after construction, you will not get the credit. So if you constructed something and thereafter you leased it out, they said there was a break in the chain because it is not the constructed asset. The construction was not for the purposes of the output supply. After construction, it became an immovable property, and thereafter you put it to use by way of lease. And the circular seems to suggest that therefore, since there is a break in chain, there will be no tax, because GST service tax credit works only when the chain is alive. That is quite bizarre. Quite bizarre because the original thinking that we had in the Mundra Port judgment from tribunal, which I thought was completely wrong, where they said that when you constructed a jetty, you will not get the credit of the inputs and input services that were used in construction of the jetty, because the jetty was thereafter used for supply of services, and not the inputs were not used in the supply of the services, which was quite bizarre, and that judgment itself was wrong. But God has been kind. That judgment of tribunal was overturned by the division bench of the High Court, of Gujarat High Court had overturned it. And now that principle was subsequently followed in Vandana Global. That principle was followed in some other judgments across the country. So if that was the jurisprudence, that this whole break in the chain is an artificial distinction that one tries to work out, I really wonder, why did the legislature actually bring about this particular clause 17(5)(c) and D? But assuming that they did so for whatever good reason, the 17(5)(c) and D will trigger only when something actually falls within the tenet of immovable property, something that is not immovable in nature. Then this restriction has no room to play at all, because 17(5)(c) does say that services used in construction of an immovable property. So it starts with that precondition that it is an immovable property. But factually, if it is held not to be immovable property, then would 17(5)(c) C and D at all apply? And you know for a fact that there have been several decisions of the Supreme Court in the context of central excise, in the context of sales tax, in the context of stamp duty, to say under what are the tests of an immovable property. And the cardinal principle of test laid down by the Supreme Court over the period of time are two. A, if the intention is to move the property, after a period of time, it is clearly movable property, provided there is no substantial damage. That is the first thing. And the second concept of immovability or movability was that if the affixation of that asset on the floor or on the land was essentially for an efficient working or a wobble-free operation, then that cannot be said to be an immovable property. So that also assumes that the intention is only for the limited purposes of keeping a stable operation, not for fastening it to the earth permanently. So if one applies those tests and it comes to a conclusion that it is not an immovable property, can anyone at all apply 17(5)(z), C and D? My view is that certainly not. Irrespective of that, irrespective of 17(5)(z), C and D, so long as it remains movable property by applying all the tests laid down by the Supreme Court, and there are any number of judgments on that, to say, and then you come to the conclusion based on the fact pattern that it is indeed a movable property, then I don't think 17(5)(c) or D is something that you need to be worrying about. But if it is an immovable property, even after applying all of that, then 17(5)(c) and D comes about. So the first test that you should follow is, in the fact pattern that your clients have, whether the asset per se qualifies as an immovable property. Now, it's a very interesting point. Look at, so there's a divergence of view that has happened between the Bombay High Court and the Delhi High Court insofar as telecom towers are concerned. Now, the Bombay High Court in Airtel's case had held it to be an immovable property. But in Vodafone's case, the Delhi High Court had held not to be a movable property. Okay, so there is a dispute with respect to whether it is movable or not. But if you were to apply the Delhi High Court decision on the fact that telecom towers are not immovable property, then for sure 17(5)(c) or D cannot be made applicable. And there could be any such example. So the first message that I want to pass is that whether it is movable or immovable has to be first seen. If it is factually movable based on all the tests that we have spoken about, then for sure 17(5)(c) and D do not have any operation. But if it has, only then we come to that. Now, assuming that we have crossed the first threshold, it has now gone into movable property, it's gone into immovable property. Then the distinction is, or the issue is that, so what it has become immovable property? If that immovable property leads to creation of a taxable supply, why would you not give me the service tax or the GST credit for that? How am I any different? Okay. So many of you are aware that that issue had come up before the Odisha High Court in the case of Safari Retreat. That was a case where a mall was constructed using various inputs and input services. Significant amount of credit was accumulated. The mall was then leased out to people, various people who would set their shop in that particular mall, and there was an output GST liability. What was argued before the court that, look, why am I not being eligible to claim credit? Because it seems like Article 14 violation, because similarly situated situation, wherever there is anybody that is doing an outward supply, you are giving them tax, but you are not giving it to me. What is the rationale? What is the basis? What is the objective that it seeks to achieve under the act? And they drew a similarity, will say that, okay, if I can understand that if I've constructed the mall and then I've sold it and I don't have any output GST, for sure I can't claim credit. But why do you want to compartmentalize us with those category where there is a sale? So, and then they also raise this, completion certificate business to say that also seems to be arbitrary for those people where it is prior to completion certificate, you bring them within the net, but if it is post GST, post so and so, you're taking them as exempt supply. So ultimately, the Odisha High Court, while it should have been a better worded judgment, but in 2 paragraphs or 3 paragraphs, they gave an effective relief. The strength of that judgment, or the strength of the judgment, or whether it will pass the Supreme Court muster, is still a debatable point. But right now, at least there is a ruling from the High Court to say that, look, you will not be penalized for having created immovable property, so long as you are making the immovable property being deployed for making further supply of taxable services. So therefore, that is something that has come in force. Now the problem is that even though it's a judgment of Odisha, and the Supreme Court says if there's a judgment of a particular High Court, interlocutory or final in nature, if it relates to central legislation, then it can have a all India enforcement. But we all know that our tax authorities are never happy with that. Even though you may flash a Odisha High Court judgment before the tax authorities, you'll say, well, I am not governed by that High Court. I don't fall under that High Court, and therefore I will not follow. So practically speaking, it's very difficult. More so because that was a decision in the context of not only central GST, but also the Odisha GST. And clearly the state GST or Karnataka GST authority will say that I am not concerned with that. I will go by what my legislation says. So there are multiple writ petitions that will necessarily have to be filed and have been filed also. In fact, in Delhi, there are more than 3 litigations, three writ petitions that have been filed. I am appearing in one of them, and there are other councils that are there in other matters. So Delhi High Court is seized of that issue, and that provision 17(5)(c) and D both have been challenged, where we are challenging the same the provision on the same ground. Okay, but what is equally interesting is that if you look at the definition of 17(5)(c), where the immovable property, they put an exclusion also. They say immovable property other than plant and machinery. Now that's a great relief, because the whole debate under the Senvat credit laws was whether it's a plant and machinery or not, whether it's a capital goods or not, whether as soon as you fasten it to the earth by foundation, does it lose its movable property, does it become an immovable property, what is it? So rightly said, they brought out this explanation in 17(5)(b) or C as well, that the plant and machinery, even if immovable property, if it qualifies as plant and machinery, you'll get the credit. And in defining plant and machinery, they say that, well, not only plant, machine, equipment, apparatus, but also the foundation under which it is standing. Now, look at it this way. If an asset is standing on a foundation, which means it is groveled to the earth and affixed in a manner that it can't be moved, therefore it is immovable and therefore it gets covered. But if per se, a plant and machinery or a machine is outside the realm of this particular section, So keep this in mind. So if your tax officer says, no, this section applies to whether it's a plant and machinery movable or not, and so long as you don't pass the test of plant and machinery, you will not get the credit, that will be wrong. A plant and machinery that takes the character of immovable nature by virtue of being a machine, etc., grouted to the earth, insofar as movability is restrained through the foundation, civil works, etc., it is those kind of plant and machinery that is sought to be covered. So that is another point that has to be kept in mind. The third thing we should keep in mind is that such plant and machinery, they have given a list that will not be treated as a plant and machinery. Okay, for example, they say land, building, and civil structure. Well, of course, why do they even have to even talk about it? Plant and machinery never carries land, building, civil structure. But they go one step further. They say that plant and machinery will also include telecommunication tower. Okay. Now I wonder why they had to put that. So I'll come to that. So telecommunication tower are excluded from plant and machinery. And what they've also excluded is pipelines that are outside the factory. Now why would you make the distinction? Pipeline outside the factory is not plant and machinery, but pipeline within the factory is the plant and machinery. Why would you distinguish between a telecom tower and a transmission tower or any other watchtower that may be there? You're willing to treat a watchtower or a transmission tower as a plant and machinery, but you're not willing to treat a telecom tower as a plant and machinery. Isn't there a discrimination that has been meted out? What is the rational objective that you're seeking to achieve by treating them separately? If towers are a class by itself, then telecom towers being selected and not being subjected to the credit regime. If pipeline is a species and you're making a subclassification to say that inside the factory is okay, but outside the factory is not okay, what does it mean? So this whole structure of the exclusion of plant and machinery, to my mind, is something that is questionable, and that provision needs to be assailed in an opportune case. So that's something that is important. The third issue that comes about is that even when you look at the definition of plant and machinery, they say that it should be used in providing outward supply. So plant and machinery should be used for making outward supply. The question is, what happens to a plant and machinery that is not directly connected to the manufacturing process? Question is, what happens to a plant and machinery that is outside the factory premises? Under those two situations, is it possible for you to take a view that these are used for making outward supply? Now, the department is taking a very contrived view of the matter. According to them, when they say that it is used in making outward supply, the use they are saying has to be a direct nexus. So they're saying that it should actually be involved physically in making the outward supply, probably something like a molds and die, which is actually used in manufacture of the component which gets into manufacturing, or various heavy equipment which are used on the shop floor for making the manufacturing process, for moving of the raw material, etc., etc. But anything which may not be in the shop floor, or which has no direct nexus, or anything that is one stage removed from the manufacturing process, they are not willing to consider. That is the view that has happened. So take an example of what happens to a railway line. Okay, a railway line that is dedicatedly prepared, installed for taking the raw material from the yard to the factory. Okay, from the tippler point to the factory. They could be at 20-kilometer railway line or 5-kilometer, 10-kilometer. We don't know, depending on the topology of that particular area where the factory is. There could be a railway line, and that railway line is partly inside the factory and partly outside the factory. So the advanced ruling views that are coming out from the authorities, all of those are obnoxiously wrong. Seems to be suggesting that no, the plant and machinery, because it is outside the factory, we will not give you. Because it is not directly involved in manufacturing process, we will not give you. Because to qualify as plant and machinery, should be used in making taxable supply. To my mind, that whole approach is erroneous, because the law does not contemplate that there is to be a nexus of such a direct nature. Because if it were to get to that situation where you are talking about a nexus of that nature, then you are actually becoming retrograde. Because earlier Senvat credit law used to say that plant or capital goods would be one that is installed in the factory. They used to have an exception which they brought out, that however plant and machinery for generation of power located outside the factory will also qualify. So place of installation was a very important determinative factor to qualify something as a capital good under the erstwhile law. But the definition of capital goods under the new law, or the architecture of GST insofar as section 7, 9, etc. is concerned, nowhere does it say that the asset has to be within the factory to be eligible to claim the credit. So, and all that is said, it should be intended to be used or used in furtherance of the business. So long as it is furthering the business, to take a dim view of the matter that location of the asset is going to be predominant or has to be looked at as a precondition for granting the credit seems to be bizarre to me. Okay, and secondly, this whole direct usage is wholly unwarranted, because when it says use in furtherance of business, it does not mean, does not require that it should be directly used in the carrying out of business. Anything that assists in value creation, or every element of economy that goes into value creation, is something that can be safely said to have gone into the furtherance of business. So direct nexus, indirect nexus, incorporated into the asset, assisted and the asset, relation to the manufacturing process, every conceivable link that you can draw, which is not remotely connection, but directly in some sense having some reasonable nexus, may not be involved in the physically involved in the actual production or the actual sale, should ordinarily be part of the sweep of plant and machinery, so far the language of used in output supply. But then this will go into some kind of litigation, and many of the companies will face the wrath of the revenue. This issue can be settled only at the court. But one thing is very clear: the three categories that they have brought out, this pipeline inside the factory and pipeline outside, seems to be quite unreasonable, arbitrary, and that can be challenged. Considering telecom towers not as plant and machinery, but other towers, therefore by implication is a plant and machinery, seems to be quite arbitrary, because the towers are towers. How does it matter whether it's for the telecom sector or some other sector? So this classification seems to be an unreasonable classification, susceptible and prone to challenge under Article 14. So that was our point on section 17.5.5c and D. Okay, we will now come to liquidated damages. Okay, and I'll if you have questions until now, I'll be more than happy to do. Maybe we should take a 10-minute question answer session now before I jump to liquidated damages, because it's a completely different subject, and before I go into that, I'll be happy to deal with the immovable property part.
Sure, sir. From petition here, actually there were certain ambiguities regarding taxability of transfer of development rights under JDA, saying GST is liable or not. Notification number 4/2018 assumes that development right is taxable and goes on to specify time of supply. Post April 2019, there is an exemption from GST for development rights to a
government.
GST for in what strong legs such exemption stands? Is it fair to argue that development right is not taxable in the first place, and hence exemption should be of no value?
So, Sujata, my point on that is very clear. Executive does not decide taxability.
Okay.
Merely because there is an exemption does not presuppose that there was a taxability. Okay, something that is not taxable cannot be exempt, but merely because you are issuing an exemption notification does not presuppose that it is taxable. That's point one. Look at the second L&T judgment of the Supreme Court, the last paragraph of that. Okay, there is a very fine line that is there. I think Justice Nariman's judgment, where he writes that merely because an exemption has been issued does not mean, and that's a fact of life. So oftentimes, in fact, if you go back in time, when software was not even taxable under the service tax law, they used to use, they had issued a notification granting exemption long back. I'm talking about 2004, 2003, 4, around that time. Briefly for 2-3 months, suddenly there was a certain vacuum on software. So this executive keeps on issuing notification more as a clarificatory thing than anything else, because the tax or revenue authorities don't understand anything other than an executive notification, right? If you have the notification, that is easy way for you. So my point is that barely because there is an exemption notification saying that development rights when provided to government is exempt, okay, should not be presumed to suggest that it was otherwise taxable. Point one. Point two, yes, I'm aware of that point of thing that, on the development right that you said. So I have settled about 2-3 days back a certain petition where this ground has been taken, and that has been challenged before a court. It will get filed shortly. I've just settled it about a week, 10 days back. So I am of the view that it should be challenged. I am of the view that we should take that it's an interest in the land. I am of the view that we should invoke Article, not Article, entry 49 and 18 of the list 2 to say that the central government does not have any power to invade into it. and therefore go on the basis, and more so because Schedule 3 itself says that sale of land, and sale of land has to assume sale of or transfer of any interest in land. After all, what is sale? When they say sale means what? Sale means divestment of proprietary rights in respect to an asset in favor of the other. It's a conveying of property, and property is a bundle of rights. Does not say that every right of the property should be transferred. Okay, so the sale has to be understood in that context.
Okay, thank you, sir. There is another question from Dhanashri Prabhu. In your discussion, you are mentioning that Article 246A, immobile property is taxable. So whereas the Schedule 3 only excludes sale of land and not immobile property. So under unlike service tax law. So would profit printage still be outside GST, sir?
Schedule 3 says sale of land.
Yes.
Land includes interest in the land. It also says building. Okay, so it therefore covers immovable property is the genus, land and building are two species out of that. So therefore, indirectly it is a non-taxability on immovable property. Any other immovable property is just not possible. Either it's going to be a building or it's going to be land. Is there a third immovable property that you and I know of?
So land includes building and all other immobile properties.
Right.
Okay, sir. There is another question from Bijal Doshi. Can you throw some light on taxability of development rights under redevelopment projects, under service tax as well as under GST in relation to notices issued by Department for Recovery of Service Tax?
See, this redevelopment projects, from what I remember, and I haven't worked on redevelopment projects for some time now, those are rejuvenation of existing flats where the builder takes over the whole thing, and in return it redevelops most of the flats or all the flats and hands it back to the existing owner and retains a new and builds new building which it retains and sells in the market. I think that is what I understand by redevelopment. So if there are originally there were 30 flats, okay, those 30 flats will be taken over by the developer. They'll be broken and flattened. A new set of 60 flats will come out, maybe, or 40 sets of flats will come out. Okay, at no cost to those owners, 30 flats will go back to those original owners, and the balance new 10 that have come out, those balance 10 the developer will sell in the market at a commercial value. That's what redevelopment is. That why I'm understanding correct? Can you ask the person who asked that question?
Yes, sir.
Okay. So effectively, therefore, there is a very complicated thing that is happening. There is a quid pro quo that is happening in as much as the owner of the land got a construction services done on their account by the developer. They were supposed to have paid for it, but they don't pay for it. Instead, they get the land, the constructed asset in return. So there is a supply or there is a rendering of construction services by one in exchange for receiving a development right from another. So services of construction have been rendered by the developer. In exchange, an FAR or a right to construct and exploit is being received by the developer, which he does subsequently by selling in the market. So it is therefore a barter. And since no consideration can be attributed in that, it's not wholly comprised of consideration, then the market value of that, cost, all of that will have to happen. So under service tax, so it will go to the cost construction method, and therefore it will be liable to service tax, subject of course to any exemption that may be there. Okay. Then when the developer, after having received the development right, okay, and having constructed the immovable property, sells the property into the market, then subject to whatever construction of commercial property or whatever else building below number of flats, that particular rate regime will apply. So the point I'm making is that this is not a case where there is a development right is being given just for a monetary consideration. This is where it is a barter of having received a construction services, in lieu thereof a development right or an interest is being given to them. So that will be a wholly different situation to my mind. Okay, But take a situation, if there was a land, I sell the development rights to you, okay? In exchange, I receive money from you. After having received the development right, you develop something I don't care, and you're selling in the market, or you're exploiting, leasing it, etc., etc. That's completely yours. Then we can take a view that this development right that has been transferred is an interest in the land. So the fact patterns changed in a redevelopment project.
Yeah, with respect to barter, there is another question, sir. Was there any exemption in case of barter under service tax? Since barter was not taxable under service tax.
No, barter may not be taxable, but there will be a rendition under negative regime. Anything that you did was a service. It has to be for a consideration. Okay, and where the consideration cannot be ascertained, then you go by the valuation rules. So as long as the valuation rules are triggered, then you are liable to tax. One thing that you can say is that, well, it has to still be money or money's worth. What used to be the definition under 66, 67 valuation? Gross amount charged, correct? And gross amount charged would mean where it is for a consideration, so and so. Where it is partly under consideration, partly otherwise, then whatever that otherwise would make up to the consideration. Where it cannot be ascertained as above, then the valuation rules will trigger. So it would have fallen under where it is cannot be ascertained otherwise. So it will still be liable to tax by taking you back to the valuation rules.
Thank you, sir. There is another question from Mr. Sagar Shah. With respect to lift installed in a building, recently we witnessed an AAR disallowing ITC for the same reason, majorly being it forms part of building once it is installed in a building. Your views on the same?
I think this is a warped interpretation. I think the test of immovability, like I said, has to be drawn by, okay, now let me go back into the jurisprudence of immovable property. So land and building we understand is immovable property. There's no doubt about that. Nobody has any question about that. Nobody can have any question about that. But there is another concept. Anything attached to the land or anything attached to the building is also an immovable property, provided the attachment is for the beneficial enjoyment of the immovable property. Okay, so anything attached to an immovable property is also an immovable property, provided the attachment is for the beneficial enjoyment of an immovable property. So when you install a fan in the house, that is not for the beneficial enjoyment of the immovable property. You're not enjoying the immovable property. The fan is for your personal consumption, for your personal health, right? The same fan, instead of being on the ceiling, could be on the table, right? So it is not meant for enjoyment of the immovable property. But a window, which is affixed to the building, it is for the beneficial enjoyment of the immovable property, because without the window, flow of air would not have happened, and it would have become a solitary confinement, and therefore it could not have had the attributes of a house or a good home, as we call it. So the question is, if the lift is contributing to the beneficial enjoyment of the house, okay, without which it becomes a Herculean to enjoy the house, then it is indeed immovable property by applying that test. So there is a divergence of view insofar as Kone Elevator's judgment of Supreme Court is concerned, where they say that it was a contract of sale, not a contract of work. But keeping that aside, stricto sensu, from an immovable property perspective, to my mind, a lift is an immovable property. There is never an intent to move the lift out. Is there any intent to move the lift out at all? No, it is affixed, permanently affixed. As long as the building is there, the lift is there. Nobody intends to take the lift out and take it to some other place. Okay, yes, because it moves on a rail does not mean it's an immovable property. Does not mean it's a movable property. That test is ridiculous. Would be ridiculous. So the test of permanency is satisfied in this particular case. Be that it is affixed to the land because for the enjoyment of that particular building, that also gets satisfied. Therefore, it is an immovable property. So it's very, very clear. Next question.
What is the applicability of GST on construction of single residential unit when material is supplied by an engineer?
No, I see. Okay, if it is in relation to any exemption notification, sorry, I'm not the person. I don't go into that kind of micro details of whether it's an exemption notification. Unless you show me the law, I will not be able to treat. So whether it's a single residential, multi-residential, subject to the nuances of the exemption notification, the position of law is very clear. If you have a immovable property that is being constructed, you procure the services, which is you procure on your own account, then 17(5)(c) gets triggered. Okay, I think that is what it is. So if the person can explain the question a little better, I'll be able to appreciate that in the right earnest.
He has not explained. There is a single line question. Sir,
Yeah,
with this,
because
we'll move on to liquidated damages.
okay, fine, thank you. So now we jump to liquidated damages. So we are almost 1 hour into our program. Another half an hour we'll discuss, and then another 20 minutes we'll do a Q&A. Okay, the question, just see some question has just popped up. Can you just read that question out?
I don't see any questions in my chat
I know, I
box.
just saw the, okay, anyway, doesn't matter.
Take it up at the end, sir.
Okay, no problem. So now there's a great deal of confusion about this liquidated damages, and there are several chartered accountants who have taken a view. They have been guided by the authority of advanced ruling in terms of those rulings where they have held that liquidated damages is nothing but activity to tolerate somebody's act, and therefore it is liable to GST. That view has been taken under the service tax era also, by virtue of this entry agreeing to the obligation to refrain from an act or to tolerate an act or to a situation or to do an act. So therefore there is a confusion which has been introduced into the market mostly by the revenue authorities and perpetuated by the professionals in the industry as well. They seem to believe that it is liable to tax because after all liquidated damages is paid for somebody who has not done his work, and therefore it is tolerating somebody's inefficiency. Let me tell you very clearly that liquidated damages is not a service that is rendered at all. There is no services involved, whether under the erstwhile service tax law or under the GST. There is no services at all. We have to understand that under the Indian Contract Act, and we have to appreciate the Indian Contract Act, therefore, in the right earnest. A consideration is defined under Section 2D of the Indian Contract Act to mean a reciprocal promise. Okay, so you offer something, there is an acceptance, and for that thing, there is a reciprocal promise that the other party pays, and therefore that is what is called a quid pro quo. So in service tax, you would have often heard the word quid pro quo, and that quid pro quo is very, very fundamental and integral for a contract of service to be in place, a contract of sale to be in place. And the government has also, in the erstwhile law, the CBC, they had issued a circular saying that prerequisite for the services, there should be a quid pro quo. If you remember, there was this whole debate about government services, whether government services entail any services at all, and therefore they had clarified, because there is a quid pro quo, because of so and so it will be service. So quid pro quo becomes very important. And quid pro quo is nothing but reciprocal promise, which is nothing but Section 2D consideration. But there is a concept called restitution under the Contract Act, which basically means that if you have said you will do something and you don't do that, then I have suffered a damage because of your non-performance. And that damage essentially means that I need to be compensated for the loss that I've incurred. So for example, you committed that you will come and perform in my theater. Basis that I went about selling the tickets, etc., etc. I borrowed some money to redo the theater, etc., etc. But you committed a breach. You did not come on the day of the show. Resultant, I suffered financial loss. Therefore, I need to be compensated for that financial loss because the date and time is gone. 7 o'clock on a Saturday evening when the show was supposed to be there, you didn't turn up. 8 o'clock, even if you came on 8 o'clock, 10 o'clock, the audience would have gone. So I cannot force you to do a specific performance of something that is just not doable. Therefore, I need to be compensated for the losses that I may have incurred. That compensation for the breach of your obligation under the contract that you so readily agreed in arriving at the consensus addendum under the contract, that breach needs to be compensated, and that compensation is called damages. Now, in a contract, when damages are very clearly etched out to say that, okay, if you do not perform within this period, which is called the delay in performance, or if you do not perform according to our satisfaction, which is the quality aspect of that, then they will certainly be eligible for a compensation. And if that compensation quantum is prescribed in the contract itself to say that under these circumstances, the damages that will be paid is going to be 100 rupees. So therefore, the quantum of damages is written in the contract itself. Then it would mean that the damages have been liquidated and identified in the contract itself. That is called a liquidated damages. That is called a damage situation where the damages are quantified in the contract. And unliquidated damages essentially means where the quantum is not ascertained, depending upon the extent of loss that you have incurred and subject to your ability to demonstrate that so much of expenses you have incurred or so much of loss you have incurred, and the appropriate court of law is satisfied that yes, indeed, that is the quantum, there such damages is called unliquidated damages. So liquidated damages and unliquidated damages both form part of what is called the contract or the concept of restitution, putting the party to the same economic position where he was at the time, at the beginning of the contract. So it is a penal charge for not performing. Okay. So therefore, there is nothing, there is no services involved. So section 73, 74 of the Indian Contract Act talks about this concept of restitution. Okay, that the party should be brought into the same economic position. So to say that, oh my God, I was liquidated damages has been triggered and he's tolerating that person's inefficiency is absolutely utter wrong. And the problem with the revenue authorities and many of the people who have pleaded before the revenue authority, I blame them as well for not having enough knowledge of law of contracts either which way, and blindly trying to follow the tax law to the hilt without appreciation of the larger law. See, today we live in an era where we're talking about a consumption tax. We're talking about a tax which operates on every walk of life of business. And therefore, under that circumstances, it is very important for all of us to harness our knowledge on general law of contracts. We have to harness our knowledge insofar as general civil law is concerned, because they all influence, they all apply, they all are relevant in appreciating tax law as well. So the whole concept of immovable property, unless you go to the General Clauses Act to understand what an immovable property is, unless you read the judgment in the case of Duncan's, which was issued in the context of stamp duty to figure out what is an immovable property, unless you appreciate the meaning of the word, what is attached to the earth, what is attached for the beneficial enjoyment of an immovable property is also an immovable property, how will you apply? Because none of these things are available in your GST Act or for that matter the service tax law. Similarly, unless you are able to bring out the understand the difference and distinction between what is the consideration and what is restitution, you will not be. Then there is, under the Contract Act, there is also a concept which is called remission of a contract. Okay, remission essentially means that, well, you are supposed to supply 100 liters of oil, but for some reason you had some problem and there was a factory lockout, something happened. You tell the contractee that, look, I can't supply 100 liters of oil. Is it okay if I have to supply you 90 liters of oil? Now, he is in breach. He was supposed to have supply 100. He is saying, I can only supply 90. Owner can stand up and say, okay, fine, I'm okay with that. Okay, even though you may supply 90, I'm okay with that. I will discharge you from the contract for not having supplied the balance 10, yet I will discharge you from the contract as if you had supplied with the entire 100. That is called a remission of the contract, basically it is a situation where the non-performance is not taken as a breach of a contract. That is remission. If under that is contemplated under section 63 of the Indian Contract. If under that kind of a remission, where the fellow is actually tolerating his inability to perform and in relation to which he is actually taking some money in return, then that could be what is called a tolerating an act. But if he is triggering a breach of contract, there is already a breach of contract and therefore is triggering a breach of contract for compensation, then it is not a tolerating an act. He is actually triggering a compensation under the concept of restitution. So bear in mind that this tolerating an act or a situation or do an act internationally also, because India has borrowed the international language, and under that circumstances what applies internationally has to be equally looked at under the domestic law as well. So if that be the case, there is no two ways in my mind that liquidated damages is certainly not a consideration for any underlying services. Nobody enters into a contract to commit a breach. Okay, that's the surest way of explaining that. Nobody enters into a contract to commit a breach, because payment of liquidated damages is in relation to an underlying supply of a breach, which presupposes that the fellow had agreed into a contract to commit a breach. That is as disastrous and strange as is possible. So therefore, keep this in mind that there is no concept of underlying supply whenever there is a damages under section 73 and 74 of the Contract Act is triggered. In the United Kingdom, this VAT SC 3560 the liquidated damages has been clarified as not to be a consideration for supplies and are outside the scope of VAT. They clarified it long back, and I don't know why the Indian authorities, even though they borrow from them, they don't borrow the good things. They borrow things that that probably need not be borrowed at all. Be that as it may. Then there is entry 22.3 of the VAT notice 708 HMRC, where they say the liquidated damages are agreed pre-estimate sums to be earned to be paid in the event of breach of contract by one of the parties. The amount is either a set figure or determined by a formula. If you receive liquidated damages, you are not receiving payment for a supply by you, and no VAT is due on that amount. Therefore, this principle is very clear also. So I would urge that whenever you have such a situation, instead of blindly falling around the advanced ruling, and as most of us are bound to follow, because that is the only legitimate jurisprudence that is available to you for want of any other high court decision. The tendency to follow the AR is very bright, and people do get scared about the ARs. But if should such a situation happen, all of this you should use to make a case for yourself, to kind of come out of the rigor of GST. In fact, there is a recent larger bench order of the tribunal in case of Repco. I think all of you are aware. It came from, I think, Bangalore, right? Bangalore tribunal larger bench gave. I think the president was sitting there, and the judgment came about. That kind of vindicates that point that I've been telling for the longest time. What did they say? They said that any compensation that you earn for breach of contract, because in that case there was a foreclosure charges that was being recovered, and foreclosure charges was essentially a charge for breach of the contract. You are closing the contract or lending agreement in advance, and therefore I'm incurring a loss, and therefore I'm seeking a compensation for that. And therefore, under the erstwhile law, they've said that it is nothing but a liquidated damages, and it is a damage which cannot therefore be treated to be an underlying service. And therefore, they said there is no service tax. The same logic will apply under the GST also. Nothing has changed. There is no differentiation whatsoever. So, Repco Home Finance is the judgment in the larger bench, which I think you should use to your advantage, and make sure that nobody is forced to pay a GST or liquidated damages. But the problem is somewhere else. Problem is that wherever people are eligible to claim credit, they don't care a damn. Because if there is a GST, fair enough, you charge, pay, claim credit, move on in life, and therefore the jurisprudence is not developing. The issue arises wherever there is this is being so-called provided or paid by an entity which is not in the credit regime. For example, a power plant. Okay, if they are receiving a GST, GST for the liquidated damages, then they have no ability to claim a credit of that, and it gets stuck into the system, and therefore that becomes a problem. So power generator becomes a problem. Anybody who is in the exempt category by virtue of an exemption notification, it becomes a problem. Anybody who is in a notification where credit are denied, for example, hotels and restaurants where the rate of tax is 5% without credit, they will get into problem. So any place where there is blocked credit or denied credit, this issue will happen. But the larger population of our country doesn't really bother, because they say it's a pass-through. Why get into a trouble with the tax authorities, and let us move on in life. Okay. So in short, and therefore my submission to all of you is that whenever you have a point on liquid damage, and I've seen articles floating around by some chartered accountants, I don't know from where they're giving opinions left, right, center, saying that it is liable to GST, liable to service tax, because of the advanced rulings. I mean, one advanced ruling I've made a reference to Maharashtra State Power Corporation Generation. There are others also which have been issued in the similar vein, but that's all wrong. That's a complete wrong jurisprudence, and we are responsible for perpetuating that if you don't take it to the high courts to get them quashed. So I think that is what I had on liquidated damages, and more than happy to take any questions, as many questions. Why liquidated damages and immovable property? We can talk about anything else, any more thing that you want to discuss. Happy to take questions now.
Sir, there are few questions on liquidated damages.
Yeah.
There are certain interpretational issues with respect to Section 74 of our Indian Contract Act, including the most important question: does the affected party have to prove that there was a damage or loss due to breach? What is the current Supreme Court view on these subjects?
See, if it is a liquidated damages, then you don't have to prove. If it is unliquidated damages, then you have to prove.
Okay.
For burden of proof, that's why people have liquidated damages in their contract, to say that there is no proof required. You are committed a breach, so if there's a delay in performance or a non-performance of quality thing, delay damages or performance damages, you don't have to prove anything. That happens and that's it, and the damages gets triggered. Of course, you have to prove that there was a delay. That you can't circumvent, because the precondition is that there is a breach in the contract. The breach of the contract is basically based on the preconditions and covenants under the contract. If either party says that no, I had not delayed, or the delay is not attributable to me, or delay is attributable to you, then that's a separate thing. But once there is no debate on whether or not there is a delay, or factually both the parties agree that there is a non-performance of a certain quality, or the performance was not up to the covenants and reps and warranties that is provided in the contract, then there is clearly no problem. Nobody's going to question it. You have to pay that amount.
So another question, sir. Even if the liquidated damages is not forming part of the contract, still is it enforceable?
Yeah, why not? Why not? How does it matter if parties get into addendums to the contract? Because there will have to be some addendum to the contract, because if it is outside the contract, it will have to be an addendum to the contract. But if it is not codified inter se between the party, then how do you even prove that such an arrangement existed? So yeah.
Does the court have to decree the liquidated damages amount as specified under the contract, or does the court assess the actual damage or loss and decree for any amount whose upper limit is as per the liquidated damage clause in the contract?
No, so it doesn't happen that way. So what happens typically is that the dispute that happens is whether liquidated damages could be triggered or not. All the dispute, because in a commercial contract, the disputes goes to arbitration. All arbitrations is when respect of whether the preconditions for triggering liquidated damages or encashment of bank guarantee as a precondition for invoking liquid damages was satisfied or not. Once that is satisfied, if there is a quantum, it all depends on what is the quantum prescribed. If the quantum is up to so much, not exceeding so much, then of course somebody will decide whether that much will be paid or not. But if it is a bullet number that so and so will be so much pre-identified, then there is no debate that will happen. So the real trouble that happens is in the arbitration is to demonstrate and prove that the preconditions for triggering of an LD clause exist or not. For example, recently Vedanta encashed the bank guarantee of Halliburton, okay, during COVID-19 period. Halliburton said, no, it was a force majeure, therefore I could not perform. Therefore, there was no delay. High Court said, sorry, the force majeure happened later. And by that time, Vedanta had encashed the bank guarantee. Okay, because that was a precondition for liquidated damages, whatever, one of the way they could have accessed. High Court said, sorry, this force majeure came much later. It came in March, okay, or middle of February. You were supposed to have delivered in November. So therefore, you were in breach. You were in breach of the contract, and they were justified in invoking your bank guarantee pursuant to the liquidated damages clause that was there in the contract. So the real debate is very less on the quantum, but more on the preconditions for triggering it.
Okay. Sir, another basic question. Is there any difference between liquidated damages and penalty under the Indian Contract Act? How does the court observe the difference between the two?
After all, what is the penalty? In fact, that section 73-74 itself starts with the word penalty. Section 73-74 itself starts with the penalty. Let me just see if I can trace 73-74 for you, and I'll just quickly read out for you also. Just give me a minute. I don't have the Indian contract right away. Yeah, it's opening.
Says in the liquidated damages.
'73. Compensation for loss or damage caused by breach of contract. Okay. 74. Let's see, where is 74? Unfortunately, I don't have it right readily in front of me. Let me see 74. That seems to be slow. Compensation for breach of contract where penalty is stipulated. So that is 74. So the word penalty is subsumed in that contract in the clause itself. Let me open it for you. Okay. Compensation for breach of contract where penalty is stipulated for. Where a contract has been broken, if a sum is named in the contract as the amount to be paid in case of such breach, or if contract contains any other stipulation by way of penalty, the party complaining of the breach is entitled, whether or not actual damage or loss is proved to have been caused, therefore to receive from the party who has broken the contract reasonable compensation not exceeding the amount so named. So this is also penalty. So there's no fundamentally difference between them. It's a penalty. Penalty means what? It's a penal consequences of non-performance, which is nothing but a restitution to the other party who has caused the loss. That's what it is.
Okay, so penalty is covered under section 73.
Yeah, 74 talks about a penalty.
Sir, what is the availability of input tax credit on liquidated damages?
If you have paid tax, then yes, why not? After all, it is in furtherance of your business. So why not? I see no restriction. 17.5, none of the 17.5 clauses comes in your way at all. So section 16 precondition of use in furtherance of business is satisfied. Okay. So I see no problem in claiming the credit either.
Okay. In one of the AARs, it was silent when this question was raised. So
The problem is that people are using the AR as a route to get the panacea. People should stop going to the ARs. For heaven's sake, stop. I mean, all of you should perpetuate. Tell your client, don't go to AR. They are killing the jurisprudence.
okay. Sir, there is another question from Shraddha Sangvi. Misappropriation of funds done by employee and compensation is required from said employee. Service tax is demanded on such compensation, treating it as agreeing to obligation to tolerate an act. What grounds can be taken to defend this?
So the employee committed fraud,
Yeah.
misappropriation of funds, and he was asked to pay it back. Was the misappropriation amount equal to the amount that the employee gave back to the company, or was it more?
Let us assume that it's same.
If it is same, then there's nothing that he is basically returning what he took. Where is the question of any service? But if it is more, then we'll have to test it. Because see, in an employment contract, none of this 73, 74 applies, because in an employee, there is no contract of service to begin with. If that be the case, the contract cannot even consider anything that is likely to be a service underlying. Okay. So I think it's a complete bogus this proceeding, and I don't think any company will say, "Oh, you've taken 1 crore rupees, give me 2 crore rupees." So subject to that, if it is the same amount, then he's basically committed a theft. He's putting the money back. That's nothing. I don't think there is any service to that effect at all.
Okay. Vivek Gupta has a question on input tax credit on liquidated damages. If liquidated damages is not supplied and outside the ambit of GST, then considering from the seller side, is he required to reverse the GST output on booking liquidated damages in its books as
So
he had paid full GST at the time of sales?
Okay, let's play it out. Let's say I am a supplier. I am to receive a consideration for my supply. I did not supply on time. Therefore, I have to pay a liquidated damages. Therefore, the assumption is that the recipient of the goods has provided the services of tolerating in relation to payment for that. Correct? Therefore, when I'm paying that amount, okay, when I'm paying that amount, I should therefore perforce pay 100 rupees plus GST on that. Correct? Because that's the thing is because it's an indirect tax. Okay, he has provided services. He's therefore entitled to recover not only liquidated damages but the tax on that. Once I have received the liquidated damages, why did I receive the liquidated damage? The performance, the toleration was for what purposes? Toleration was necessary for me to have a project at a given to be completed in a time-bound manner. So this tolerating this supply of services of toleration was necessary concomitant to further my business. And furthering my business, if I had to pay this tax, then I should certainly get a credit of that. If you say that it is not an underlying supply, then the question of paying the GST in the first instance should not have happened. If somebody has already paid the GST, the presumption therefore you make is that it is a taxable supply. The law cannot take a contrarian view. When it suits them to levy the tax, it is a supply. When it suits them from denying the credit, they cannot say that it is not a taxable supply. You have taken a wrong credit. That is completely bizarre. You have to make a consistent position of either you should not have taken the tax, you should have forced the fellow to pay the tax, okay, or you should not have claimed the credit. Either which way. Having paid the tax, then of course, then you have to take it to the logical thing, because the presumption is you had made a taxable supply.
So next question. Can liquidated damages be treated as deficiency in service? Hence, can credit note be issued for such damages?
No. It is not deficiency in service. It is a deficiency, it is based, but a breach. What do you mean by credit note being issued? Credit note means what? You're reducing the contract value. So under sales tax law, people used to do that. So if the sale price was 100, liquidated damages triggered is 10 rupees. Therefore, the invoice used to get raised for 90 rupees because of the credit note adjustment. And they would offer 90 rupees to as taxable turnover and under sales tax. Courts have very clearly said, sorry, those are two different transactions. You cannot, merely because netting off is possible for an accounting treatment perspective or from a cash movement perspective, does not mean that turnover comes down. Your supply value remains 100. Your credit note is basically a way to adjust the flow of money. But the accounting treatment cannot be that the net sales reduces from 100 to 10. Your net sales in your turnover or your income will always be 100. Your expense line will be another 10.
So next question from Dhanashri Prabhu. Notice period recovery in employment contract. Would it become liquidated damage and tolerance of an act?
I don't think so. I don't think so. There is nothing that he is tolerating. Nothing that he is tolerating. There was a contract. The contract provided that you shall stay for 3 months. Okay. He leaves or he or she leaves by the first month, which means that the company is at significant difficulty to find an alternate resource within such a short span of time, and therefore it is a deterrent that is used as opposed to any toleration that is being provided about that. I don't think that is a service at all, and I know there are several show cause notices that have been issued floating around in the market on that.
Another question from Purushottam Bora. Insurance claim in case of loss of profit, any taxability? Is there applicability of GST on that?
Can the person explain this question?
Insurance claim in case of loss of profit.
So, which means, okay, what he's basically saying that I had a, let's say, office building. There was a general insurance to that property. There was a fire that broke out, okay, and I received a compensation from the insurance, insurance company, okay, which is the insurable interest in that property I've received from them. Is that the question? Whether that money that I received can be said to be in relation to some service that I provided to the insurance company? Is that the question? Can you ask the person to clarify? Can the person please clarify that the receipt of the insurance claim from the insurance company, is that under any underlying supply that I have made? Is that the question?
Insurance claim in case of loss of profit.
No, loss of profit means loss of business. What else claim can you make? Because insurable interest will be that. So let's see, where does one draw the line between? No, so this is different. Sorry.
Okay.
So can you just ask the person this clarity?
Yeah, we'll move on to the next questions.
Right.
Non-performance or breach of contract.
Sorry. Can you repeat that? Can you repeat that?
Non-performance or breach of contract settled in arbitration comes under liquidated damages as per GST Act. Okay. Then the
Who says it comes under GST Act? Where does the person say or see that it comes under GST Act?
Sir,
it's an assumption that the person is making, isn't it?
Sir, we are directly referring to Schedule 2(5)(e) and probably government of an act.
That is a presumption.
that is a direct relation which comes into our mind when we say.
No, it is not. That's what I'm trying to tell you all. Please, it is not. Nobody is tolerating anybody. It is a restitution. Now you have a larger bench judgment from the tribunal also. Please read REPCO, you'll realize that. And I've been telling for the last 2.5 years to people, it is not a toleration by any means. So
So that is the basic idea of conducting these programs. Everywhere it is mentioned that liquidated damages are liable for GST. So we are giving a different opinion. So I hope this is helpful for all our viewers.
true, true.
Tax adjustment can be taken on output to that extent. If I purchase a flat from a builder, I think he has posted a question relating to the previous session.
Please.
If I purchase a flat from a builder and pay GST to him and transfer the same flat to some other person before registration, am I liable to pay GST on the same?
It's a very good question. Whoever thought of it. I have to open the legislation. Just give me a minute. Just give me a minute. A very interesting question. I don't think it will be liable. I don't think it is liable. Because you are not providing construction services. You may have received a construction services. Before completion certificate you have purchased, therefore GST. But when you sell, when he sells it, when he or she sells it further down, you are not providing a construction services. You are actually selling an immobile property. I don't think that 5A of Schedule 2 or 3 will be Schedule 2 will get triggered at all. I don't think so.
There's another question from Vinayak Power. Whether cum duty calculation is allowed under GST Act as provided under Finance Act 1994.
Yeah. You can use it. There's no problem.
Okay. Then another question from Purushottam Vora. Fire broke out and business was stopped for 4 months. Insurance claim received from insurance company for loss of profit, ailing with claim for loss of plant and machinery.
Mm-hmm.
The question is incomplete.
So I've understood. The person is trying to clarify what this amount was for. So the answer to that person is whatever you received from the insurance company is not for any underlying service that you have done. You had entered into a contract of insurance with the insurance company. Insurance company has provided you a service of insurance for which he would have charged you a GST for all the services of what is called an assurance services, that should you be in a problem, he will compensate that. At the time when you receive the money, you have received the money under a contract of insurance where the service provider was that fellow. And you are basically getting the benefits out of that contract. So there's no second contract or second service that you are providing for receiving this money. So there's a question of any service tax or GST that might be there. There's a question, where does one draw a line between liquidated damages or something that is popping on my screen? Can you read that question?
Yeah, sir, I think there are questions coming directly to you. Can you please answer those questions?
Acha, the question is directly coming to me. Why are they sending it to me? They should send it to you. Sorry, I have not been seeing my chat box. I was only listening to what Sridhar was saying. Where does one draw the line between liquidated damages and cancellation charges fees? If an airline ticket is booked but is cancelled for a fee, is that in the nature of liquidated damages? Oh, what a question. Who is Venkateswaran TR? It is TRV. Is it TRV, my old TRV friend from my BMR days? Okay. How are you, man? Okay. So I expect. So great. Okay, TRV. Good to see you here. So yes, there are huge amount of jurisprudence on that. Huge amount of jurisprudence on that. The three line of judgments that are flown from the European Court of Justice in the EU jurisdiction. So original thinking was that. So the first case that came about was when there was a hotel room and a room night, which was bought, and the person did not come, and they had to forfeit the deposit that was given. That was held to be a damages, and the court said that, look, it was an opportunity cost It is essentially a penalty and a compensation for loss of business, and therefore it's nothing but a damages. That was the first line of judgment. Okay, the second set of judgments that came was in a situation where they said that there was an airline. The airline, you buy a ticket and you do a no-show, and irrespective of whether you fly or you don't fly, the no-show basically means you forfeit that amount. That was challenged, before the court. They said it is a service involved, and the court said no. The fact is whether you came to the airport or you did not come to the airport, the aircraft would have continued to render the services of airline services, and therefore you cannot say it is a damage. It was part of his business operation. It would have been business as usual for them. You came or you did not come. Therefore, they said it is certainly a taxable activity. You cannot say it is a damages. Third judgment which came subsequently was where there was a contract. I think it's judgment of Mio's case. I think the contract was for, let's say, 15 years. The contract said that if you terminate any time earlier, and let's say the contract was for 15 years, and the consideration payable for the whole contract was 100 rupees, and it said that if you terminate in the 5th year, and on the 5th year the balance contract period you owed me 7 rupees, then you will need to pay me 7 rupees for having breached the contract in the 5th year. Then the court said that it is not a liquidated damages because you are extracting the balance period's money. Therefore, it is actually a consideration for the entire contract period. So yes, there are nuances, as TRV rightly points out. Those are complexities that happens in a commercial transaction, and therefore the devil lies in the detail, and the contractual words will have to happen. I hope TRV I have answered your question. What is the next question? Let me see. People have sent me questions. Hold on.
So there are.
Okay, how will this apply layering charges involved for conversion of land? How will this situation apply for layering charges involved for conversion of land to make it available for land registration? Oh, well, any such layering charges is nothing but a facilitation charges. You better pay GST on that. That is nothing to do with the land. It is nothing to do with the interest arising out of land. This is an additional services that you need to exploit the land. So please pay your GST on those layering services. No questions asked on that. Post April 2019, there is an exemption from GST for development rights. Oh, we spoke about that. Okay. Okay. Any other question? Lift, we spoke about that. ISO taxability and services register free of cost construction services got in return for existing tenant. We spoke about that. We spoke about barter, GST and construction single residential unit. We spoke about that. Schedule 2 5B, Schedule 2 construction of complex building, civil structure or part thereof, including complex building intended for sale to the buyer or wholly partly, except where the entire consideration has been received after issuance as his first occupation, which was earlier. What is the meaning of first occupation? First occupation means that the virgin state, not a resale state. First occupation, because when the occupation certificate is issued by the authority, it says that it is fit for occupation. That is what it means. Okay, so I don't have any other questions here. Just one. So where does one draw the line between LDs and cancellation charges? This Venkat, I have TRV, I have responded. Mrs. K Food Industries Limited, Allahabad Service Tax Finance against revenue in the subject matter. What is this Allahabad? I don't know. K Food. What is? Whoever has written this, can they come on the mic and explain? I haven't read this judgment. Maybe I know the concept, but I don't remember the judgment. Query on barter transaction. Let us assume GST 80% enters into a barter transaction with another GST estimate in such a way whether GST is required by discharge. Well, this is a perennial problem, and I've been raising this point for a long time. In a barter, there has to be a corresponding consideration. Which one will you consider as a consideration? Which one will you consider as a supply? My view is that once it is treated as a consideration in relation to a given supply, that same consideration cannot become an underlying supply. So you have to arrest it there. They cannot, otherwise it will keep on going, it will keep on becoming a circular reference, which is not what the law should be. So that is how we should deal with it. Okay, so any other question from you?
Sir, this question I'm just reading out. Where does one draw a line between liquidated damages and cancellation charges or fee? If an airline ticket is booked but it is cancelled for a fee.
I just explained that. I just explained too. Yeah.
On barter transaction, damages forming part of contract. Even on non-performance, is it advisable to add addendum in contract that quantum of liquidated damages is nil to safeguard against the revenue against taking them a view, is it an act of toleration?
No, no, no. Why would anybody do such a thing of putting a amount as nil? Then where is the question of tolerance? No. What are you tolerating then? See, the figure is you trigger liquidated damages because commercially you need the money. If you're not needing money, what is this addendum to say that there will be zero consideration for that? And it's a hogwash. Get it? You understand what I'm saying?
Kindly share your views whether power plant is immovable property or not.
Yes, it is an immovable property, no doubt about that. There is absolutely no doubt about thermal power plant being an immovable property. There's absolutely no doubt at all. A solar power plant, we can have a debate, but thermal power plant for sure not. It is an immovable property.
Mr. Manish is asking how far construction should be construed in under section 17(5)(c), narrow or wide. Suppose surveyor's services, it is not directly attributable towards construction of immovable property, is it eligible for ITC?
So 17(5)(c) says works contract services supplied when supplied for construction of an immovable property, except where it is an input service for further supply work. So this basically says if you're a subcontractor giving it to a contractor, contractor can't claim credit. Correct? So what is the problem in that? I don't see any problem. If you're not doing for trading of the services, if you've received a works contract services, which is not but a service for construction of an immovable property, okay? So works contract service is defined to mean construction, alteration, renovation, etc. in relation to immovable property. For construction of an immovable property, which is very clear, construction means all of those things. Construction has been defined in your section also. Your just one sec, construction. Where did they define construction? I remember construction was defined. Anyway, I can't see where it is defined. They seem to have defined construction somewhere. So anyway, so works contracts is defined for you, which very clearly brings about that it should be alteration, contract for building, construction, fabrication, completion, erection, installation, any of these things that happens wherein there is a transfer of property, and therefore it will become. So I don't see any difficulty. What exactly is the pain point? If you can give me a fact pattern, I'll be able to analyze that better.
Okay. Sir, we will take the questions later from him. Probably we'll forward it to you, sir.
Sure. Please ask the person to reach out to me directly.
Yeah. So next question from Uday Kumar. Whether writing back of unpaid creditors now, maybe in the year 2021, relating to period earlier to GST era, whether it attracts GST or not.
Basically, what is it? You are writing off a debt? In other words,
writing back of unpaid creditor.
Unpaid creditor. Which means what is the context, if you can explain, because unpaid creditor.
He has to pay some amount to creditors, which he is not paying now.
So he had to pay some amount to a creditor, which means that he had
he
had purchased money, goods, he had to pay that amount, and he's writing it off. Correct?
Yeah, return back.
He's writing it off, which means that the consideration earned by the vendor has dropped.
Yes.
Right? If that is the case, where is the supply? I see no supply that has been made at all. Writing off, or basically saying that I don't recognize this as a debt anymore. Now the question is, did he take it through a Tran 1 for a credit? He could not have, because no credit would have happened if he had not paid for. That credit would not have come to him under the erstwhile Senvat credit laws. Okay, more than 180 days. Correct, exactly. So if he had not paid, there was no question of any credit. If there was no credit, Tran 1 could not have got filed. If Tran 1 could not have got filed, GST Act is not getting affected by any means. Writing off is not a supply. So I don't see any GST issue at all.
Okay. Any other questions that we...
Fine. So if there are no other questions, I think we can end it now. What is
Sir,
it?
there is another question from Manish. Let me explain. The ICC is not available on goods or services used for construction. So how do I come for construction? Is that every goods or services which is even remotely connected to construction of immovable property that is ineligible, or should it only mean those goods or services which goes in creating the superstructure?
Okay, then the question was not in the context of 17.5c. The question was in the context of 17.5d. Because 17.5c only talks about works contract services. 17.5d says goods or services are both received. Basically, then anything that you purchase on your own account, you will not get the credit, sir. So long as it is used for construction of immovable property. It is individually. Okay. For construction of an immovable property means meant for the purposes of construction of an immovable property. Which means if for construction of an immovable property it is commercially expedient and necessary for you to purchase such as those things, even paints, varnishes, or anything goes into for the construction to beautify, all of that will get subsumed into that.
Sir, there is a question from Raj Praveen. He says, oh, there is related, directly related. Since in Mohit Mural's case, High Court said IGST is not applicable on ocean freight. Can department question ITC availment on the same?
Okay. It's a logical thing. If tax was not payable, credit cannot be accrued. And if the levy is found to be wanting, it goes back in time, which means from the day one, the collection of tax was unauthorized. But having collected the tax, they had deposited it. Better course of action would be to claim a refund. But now that you have claimed a credit of that particular thing, you are in default because the High Court judgment is always retrospective. So the better thing to do is that you having incurred the cost of that tax, you should reverse the credit, and it may sound very strange. You should reverse the credit and file a refund claim. Right, but the problem is that the rate of interest on reversal is higher than the rate of interest on refunds. It's a problem.
So there is another question. Whether leasehold improvements like interior will it be eligible for input tax credit?
It will get knocked down by virtue of C or D.
Okay.
Because this improvement will qualify as works contract, isn't it? Renovation, right? That's what the word says. Hold on.
Covers.
Yeah. It will get covered. Contract for building, construction, fabrication, completion. Renovation will fall under completion. Erection, installation, fitting out. It will get covered under that. Improvement, renovation will covered under that. Modification, it will get covered. So, so hardly any way to come out of it.
With this, I hand over the session to Ganesh and again, or indirect.
Okay.
Sujit sir, I have got one question on my WhatsApp from one of our member, Padmashri Patil. The question is, what will happen if I sell flats allotted under GDA from builder before completion of the project? Is it not a sale of private construction property and not flats after completion? I think this question asked by somebody already, but please throw light on this again.
See, if it is sold before completion certificate, then clearly it's taxable, isn't it?
But he's a retail customer, sir. He's a retail customer who has bought for his use and subsequently is selling.
No. I'm on the first leg.
Yeah.
When the builder sold to him, it was sold to him before completion certificate.
Right.
Correct? Under that circumstances, it is liable to GST. The question is what happens in the second leg. Correct?
Right.
The second leg, the question is, will it qualify as a construction services? It will not qualify as a construction services. Will it qualify as a construction services? Of course, now the schedule will have to read back to 7.1A and not 7.1A will take you back there. Because these are all deeming provision for classification now, isn't it?
The business will not
The
satisfy.
business, precondition of business will not get satisfied. That's what I'm saying. So it will not get, the second leg will not qualify as a construction services. Perforce, therefore, you'll have to go to 7.1. It should be in furtherance of a business. You are not a businessman in this. Of course, the definition of business does not warrant you to have volume, frequency, etc. anymore. But nevertheless, you should be engaged. If you're if that is not your trade, you can certainly say, I'm not in that business. So I doubt whether the second one will be liable to tax. That's my preliminary view.
Right. Yeah, there was one more question, sir. Whether installation of lift in a building can be considered as a part of immovable property or immovable property.
I answered that question. I said it will be immovable property.
Okay, fine. So the last question is Safari retreat. This is my question. Safari retreat, a decision by Orissa High Court. Now it is pending with Honorable Supreme Court. Your views on that? How? What is the trajectory of?
You see, that judgment was argued brilliantly by the learned counsel, but badly drafted by the judge. He did a complete injustice to the industry by writing 3 paragraphs. The doctrine of reading down the way he has applied is not the right way in which reading down has to happen. So I'm not too sure whether this judgment will stand the scrutiny of test before the Supreme Court. Therefore, we have to have other high courts pass a reasoned order, detailed order, not as flimsy as the Orissa High Court judgment. So very well argued by Ganesh, but very sadly drafted by the judge.
Right.
But the point that they have raised is genuine. It is worth considering.
Okay. Well,
Okay.
Yeah, thank you so much, sir, for this connect between North and South. Really pleased to have you on TSCA platform for the very first time, and we would look forward to for your support and guidance on the IDT GST issues which we might have in future. I would like to place on record, appreciation to you for having spared your valuable time this afternoon. Okay. I also thank all my EC committee members, Vijay Kumar Patel, Vinay Bhatt, and Sujata Raghuraman for working hard to make sure this webinar session goes successfully. Thank you all of you, and stay safe. Thank you. Thank you, sir.
Thank you all. Thank you for having me. I hope this evening's conversation made some sense. If you have any more specific ones, reach out to Ganesh. He'll reach out to me, or you can reach out to me directly. Happy to have a conversation. Thank you all. Have a good evening. Bye-bye.
Thank you.